You're making at least 3 of these 5 money mistakes right now, and none of them feel like mistakes. There are 5 specific financial habits that quietly drain wealth from ordinary people for decades. They do not feel like mistakes while you're living them. They feel like normal adult life. That is exactly what makes them so costly. By the end of this video, you will know all 5, what each one is actually costing you, and the exact step to fix each one starting this week. These 5 mistakes are not limited to people with low incomes or little education. Right now, they are happening to teachers, engineers, small business owners, and people earning 6 figures. The reason they persist is not laziness. It is a specific gap in financial knowledge that nobody ever formally filled in. So let us go through each one and close that gap. The average American household without a written budget wastes $400 per month in spending they cannot trace or explain. That is not money lost to emergencies or bad luck. It is money that drifts out through small, untracked purchases and forgotten subscriptions. Over 10 years, that drift adds up to $48,000, not spent on anything meaningful, simply gone. The simplest budgeting framework that actually sticks is the 50-30-20 rule. 50% of your take-home pay covers needs: rent, utilities, groceries, transportation. 30% covers wants: dining out, streaming services, travel. 20% goes directly to savings and debt repayment the moment your paycheck arrives, before you spend a single dollar anywhere else. Automate that 20% as a transfer on payday, and you will never feel the loss, but you will absolutely feel the gain over time. Budgeting keeps the money from disappearing. But mistake number 2 is different. It is one that even disciplined savers fall into. And unlike overspending, it never shows up on your bank statement. It shows up 30 years from now, when you finally do the math and realize what waiting actually costs you. Mistake number 2 is waiting to invest. Most people plan to start once the market calms down, once they eliminate a debt, once they get the next raise. The market never fully calms down. There will always be a rational-sounding reason to wait 6 more months. And every month spent on the sidelines is a month of compound growth that cannot be recovered, not with higher contributions later, and not with better stock picks. If you invest $500 per month beginning at age 25, you retire at 65 with $1.7 million. Start the same habit at 35 and you end with $742,000. Wait until 45 and the total falls below $300,000. The monthly contribution is identical. The rate of return is identical. The only variable is time. And those 2 10-year gaps cost you close to $1.5 million combined. Compound interest does not grow in a straight line. It accelerates. The returns from early years generate their own returns in later years. That is why a single decade of delay produces a gap that widens permanently and cannot be closed by contributing more later. The person who starts at 25 and the person who starts at 35 can contribute the exact same total amount of money over their careers. The one who started earlier will still retire with nearly twice as much. For most people beginning to invest, a low-cost index fund inside a tax-advantage account like a 401k or IRA is the correct starting point. These funds track broad markets passively and have outperformed roughly 90% of actively managed funds over 20-year periods after fees are accounted for. You do not need to research individual companies. You do not need to time the market. You need a consistent monthly contribution and the discipline to leave it alone while compound interest builds. Mistake number 3 is the quietest one on this list, and the one your bank hopes you never examine closely. You are probably keeping your savings in a traditional bank account earning almost nothing, and your bank is counting on the fact that most people never stop to calculate what that actually costs them each year. The national average interest rate on a traditional savings account today is 0.01%. On a $20,000 balance that earns you $2 per year, the bank rounds it at the end of the quarter, and it barely moves your balance. A high-yield savings account at an online bank currently offers between 4 and 5% annually. That is $900 on the same $20,000 for the same calendar year, with no additional risk and full access to your funds at all times. Inflation runs at roughly 3% per year. If your savings account is earning 0.01%, you are not just earning less. You are losing purchasing power every single month while your balance appears to stay flat. Opening a high-yield savings account takes about 15 minutes online. You keep the same immediate access to your money. There is zero market risk. The only thing that changes is the rate at which your money grows. And over 10 years on a $20,000 balance, the difference is over $11,000 in earned interest. The next two mistakes are where most people lose the largest amounts of real, calculable money, not through gradual drift over decades, in concrete dollars with specific numbers attached that you can look up and verify today. And in both cases, the fix is something you can do in under 15 minutes. Mistake number 4 is not capturing your full employer 401k match. Roughly 20% of American workers who have access to an employer match do not contribute enough to receive all of it. Their employer has contractually agreed to add free money to their retirement account, and they walk past it every 2 weeks without collecting. On a $60,000 salary with a standard 3% match, that is $1,800 in free annual compensation sitting uncollected. That $1,800 annual employer match, left to compound untouched over 35 years at an 8% average return, becomes $284,000 at retirement. Not from your contributions, from the match alone. If you're not sure whether you're capturing your full employer match, log into your HR benefits portal this week and check your contribution percentage. Contribute at minimum enough to receive every dollar your employer is offering. This is the highest guaranteed return on investment that exists in personal finance. A 100% immediate match with no market risk on the downside. Mistake number 5 is treating high-interest credit card debt as a permanent background feature of adult life. Millions of Americans carry a revolving balance every month and consider it a normal cost of living. It is not normal. It is one of the most aggressively priced financial products that exists, running quietly in the background and compounding against you every single day the balance remains unpaid. The average credit card interest rate in the United States is currently close to 25%. If you're carrying a balance at that rate, while simultaneously investing in the stock market at 8 to 10% annual returns, you are losing approximately 15 percentage points per year in that gap. No index fund, no growth stock, no investment strategy cancels out 25% compounding interest working against you. You cannot invest your way out of high-interest debt. You have to eliminate it first. There are 2 proven frameworks for eliminating credit card debt. The avalanche method targets the highest interest balance first. Mathematically optimal, it saves the most money over the payoff period. The snowball method targets the smallest balance first, giving you early paid-off accounts that sustain motivation over months of effort. Research consistently shows the snowball method produces better real-world completion rates, even though the avalanche saves more on paper. The correct method is not the one that looks better on a whiteboard. It is the one you actually follow through to a zero balance. Every mistake on this list shares one characteristic. Not one of them feels like a mistake while you're living inside it. No budget feels like drift. Waiting to invest feels like caution. A savings account feels like responsibility. Missing a 401k match feels invisible. Carrying debt feels manageable. That is the nature of these habits. They are comfortable, they are common, and they are expensive. These are not estimates. Every number on this board is a real, calculable cost tied to a habit that feels unremarkable. $48,000 in a decade from untracked spending. Nearly $1 million from a 10-year delay in investing. $11,000 for parking money in the wrong account. $250,000 from never claiming free money your employer already committed to giving you. You do not have to fix all 5 this month, but you should fix one this week. And the one that stings the most right now is the right one to start with. Here is the 4-week plan. Week 1, set up your 50-30-20 budget and automate the 20% savings transfer on payday. Week 2, open a high-yield savings account. Most online banks require 5 minutes and no minimum deposit. Week 3, log into your HR portal, find your 401k contribution percentage, and raise it to capture every dollar of employer match. Week 4, write out every debt you currently carry with the interest rate beside each one and choose between the avalanche and snowball method. On day 30, review what changed and set the next month's target. The difference between people who steadily build wealth and people who stay financially stuck is almost never income level or natural talent with numbers. It is almost always a handful of small, specific decisions, made consistently or not made at all. The math behind each of these 5 fixes is not complicated. The habits are not difficult to form. What is rare is the moment when someone stops, looks honestly at their own situation, and decides to make one different choice today instead of next year. If this video gave you even one thing you did not know before, that is enough to change a number on one of those boards. Subscribe for a new video every week. Practical, honest conversations about how money actually works. No hype, no shortcuts, no promises that are designed to sell you something. Just the real mechanics of building and keeping wealth over the course of a life. I will see you in the next one. Subscribe and turn on notifications so you never miss a video. New content every single week, actionable and always free.